Let's get some more perspective from an investor on some of the big tech earnings that have crossed. We want to bring in now Ross Gerber. He is co-founder and president and CEO of Gerber Kawasaki. Ross, always a pleasure to speak with you. I know that you look at Tesla very carefully, and the results are out. And I know that the stock has moved independent of what the company has told us about the sales of its EVs. But I do want to get your take on the gross margin number that came in for the fourth quarter. Automotive gross margin, when you back out the regulatory credit, was 13.6%. Is this enough to move the stock in for those who are fundamentally focused on Tesla?
Well, I think this is actually a bad number, right? I mean, gross margins continue to decline even after all the layoffs and stuff last quarter where they got the benefit of higher margins because of that. Now margins are continuing to decline because they're having trouble selling cars for obvious reasons. And so, it's really a game for Tesla of like, they can manufacture actually a lot more cars than they're selling, so they just hold back. And then they have to do pretty much every demand lever possible to get rid of the vehicles. And so we're seeing it in the numbers. And once again, I'm not surprised by it. Mm-hmm. They don't advertise, and the only advertising they have is Elon.
Right. Well, he's a pretty effective advertiser, we got to say. Ross,
not for cars.
Not for cars, for other things, yes. Well, I mean, at some point, does the tide turn on Elon Musk and the gains that we've seen in the stock, up 55% since the election, up 83% since the last earnings, start to drive down the stock in a way that's, again, divorced from fundamentals of the vehicle business?
Well, once again, the stock is actually down over the last 3 years. So when you look at it from 3 years ago, we haven't made any money in Tesla. And at that point, they were expected to do $4 in earnings, and it traded at 100 times earnings in 2021. So we were at $400 a share. Today, we're at $376 a share with $2.46 in earnings. So when you actually look at Tesla's financial performance over the last 3 years, it's been horrible. And so this is a growth company at a huge multiple that isn't growing. So what's going to get it to grow? That's the big question.
Well, I am curious, just beyond just building cars. I mean, there was this whole narrative, or at least really a whole model into the thesis, the bull market thesis of Tesla, that it was more than just a car company, that some of the technology components, AI, autonomous driving, blah, 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 all this sort of is what gave it such a higher valuation relative to a GM or Ford. It was a tech company. Is it still a tech company? And if so, when can we see them actually leverage some of that into real growth?
I mean, there's no question that it's a tech company in the sense of its focus really is on software and developing software for robots and autonomous vehicles. But their core business is selling cars and energy storage and charging. And that's what Tesla was founded. His mission is to advance sustainable transportation and energy, and that they were doing a wonderful job before they pivoted into a bunch of businesses that we're not sure how they're going to be, which is robotics and cybercabs. So, and that's not coming anytime soon either. So I just come kind of like asking the question of like, where does the growth come from over the next several years until these technologies work? I use full self-driving every day, and now I see Waymos every day all around me driving perfectly fine, and my car still can't do it. So I don't care how many times Elon says that it's going to work this year, and this is the year of full self-driving. It's just a bunch of crap at this point. It doesn't work. It still doesn't work. So it works pretty good. I like it. But it's driver assist. That's where we're at still.